All right, welcome back to Vol Studies. Today we cover Chapter 4, or Expiration, Profit, and Loss. The purpose of this chapter is to introduce you to parity graphs, which I'll often refer to as expiration P&L graphs. So if you hear me switching between the two, just know that we're talking about the exact same thing. The intent here is to get you familiar with an option's expiration, profit, or loss. Now at expiration, an option is either worth something or nothing. An out-of-the-money option settles into a value of 0, returning nothing to the holder of the option, whereas an in-the-money option will have a payoff determined by just how far in the money that option settles. And of course, for a call option to expire in the money means the strike price is less than the underlying price at expiration. And for a put option to expire in the money, it means that the strike price is higher than the underlying at expiration. Another way to put this, at expiration, a call option's settlement value is going to be the greater of 0, or S minus K, where S is a spot value and K is a strike price. That determines how far in the money that call option is. And once it's in the money, the call option has a delta of 100. It's entirely intrinsic, and the slope is 1.0, the same as the slope of the underlying. If you were short that call, you'd have a delta of negative 100, or a slope of minus 1.0, as it would move just like you were short the underlying asset. An out-of-the-money call has no value and no slope. Effectively, at expiration, the delta is 0 or 100, and this is the concept that leads us to these payoff profiles, because the delta at expiration is going to be used as a slope on our graphs. Now, moving over to put options, we know that put options give the owner the right to sell or put back the underlying asset to the writer of the option. This means that instead of a payoff determined by S minus K, we flip this, and the payoff is K minus S, or 0, of course, because the payoff of an option to the owner of an option cannot be negative. Again, the difference here is the greater of 0, or strike price minus the settlement value. To the option owner, an in-the-money put option has a slope of negative 1.0, or a delta of negative 100. This simply means that it's going to move 1 for 1, but inversely with the underlying asset, just like you were short 1 unit of it. Now, just like we talked about with call options, moving between a long put option and a short put option requires you to flip the payoff profile across the x-axis. So a short put option then has a delta like a call when it's in the money. When it's out of the money, it still has a 0 delta, or a 0 slope, and of course 0 value. So some key points here. The main takeaway is to remember, when you buy an option, you have limited risk, a very defined risk, which of course is the amount you paid for the option, but in theory, you have an unlimited payoff potential. Now, of course, in reality, that's bounded. For example, you're not going to buy a put on the S&P 500 and observe infinite returns. These things are bounded in practice. But of course, the main takeaway here is the leverage implied when you have payout ratios, because you can achieve returns in multiples of your premium spent. Of course, sellers do have the opposite profile. When you sell an option, you're taking on, in theory, an undefined risk. Again, it's bounded in reality. But you're taking on risk that is far in excess of the premium you receive. It's much like the way insurance premiums work. Now, of course, when you look at the different risk-reward characteristics between buying options and selling options does not seem very attractive. However, the important takeaway here is, much like insurance products, the majority of the time, the options simply don't pay out. We'll look at this later on when we talk about probability distributions, but of course, just generally speaking, you should know that there is an equilibrium level of supply and demand here, and typically, just like insurance, that leaves a premium implied, a difference between what a seller collects and what he's expected to pay out. Now, moving on, we're going to take what we just talked about in terms of the expiration P&L value and slope, and use this to begin constructing P&L profiles, actual graphs of not only option payouts at expiration, but option structure payouts, and of course, hedged option structure payouts at expiration. This is fairly straightforward. It's just arithmetic in the end, because any option combination can be plotted by adding up the components of the strategy with the right multiplier. Now, I'm going to take us on a little bit of a detour with respect to what Natenberg has put in the text itself. Now, of course, I encourage you guys to go through the examples, the combinations in the book until you're comfortable with it. But the examples I'm going to give you are going to be more immediately useful in assessing payoff profiles of actual hedged options spreads. These are the things that I was drilled on in training with a market-making firm. Now, the point is not only to get yourself familiar with the different types of spreads, but to get yourself familiar with the different types of outcomes that are either beneficial or not beneficial to the holder or the short side of the hedged structure. This will give you a strong foundation when we start talking more about dynamic hedging influences. Again, my minor adjustment is mostly going to involve the inclusion of the hedge asset or the underlying asset. Now, while Natenberg introduces the underlying contract as a unit quantity or an integer as part of a combination of different integers of an option, I think it's not only more intuitive, but really applicable to the way we trade to think about structures as one-up spreads or single strategies that are hedged on a delta. Instead of using whole integers, we're going to drill down into option spreads and strategies and hedge them with fractional shares of the underlying, exactly as you would if you were a market maker or trading volatility delta neutral. Now, in practice, what this means is when we do these P&L graphs, we start with an option structure or strategy. You can start as simple as a long 20 delta call, for example, against which the market maker's hedge would be short 0.2 units of the underlying. That's where the 20 delta comes in. As we do these graphs, from our perspective, which again will be the perspective of a market maker who's trading volatility, meaning they're hedging their delta to delta neutral at the time of the trade, your hedge asset, for example, has a P&L slope that's going to be linear throughout the entire graph. But when it comes to the actual options themselves, you'll have to return to the heuristics we talked about before with respect to whether the option is in the money or out of the money and the associated slope for that range. We'll go through this simple example together to help it make sense before you go ahead and try some examples on your own. If you're following along live with the initial cohort, this example should look familiar, if not now, then by the end of the month. This is asking you to draw the expiration P&L graph for the topmost strike in the JP Morgan put spread collar trade that will happen at the end of this quarter. Now, if you guys don't know, that fund has an underlying book of equities against which they buy a down 20%, down 5% put spread, and fund it by selling whatever call they can to make the entire structure trade even money or flat premium. Now, in choosing this example for its relevance, I'm starting out simple with just one leg of the three-leg structure. That means this call will have an associated premium. It will not trade flat. Against a reference of 57.33, the trade is to go long one SPX 60/20 call for a price of $56. Now, that's the debit. That's the premium you pay for the option to open the trade. The example says hedged on a 28 delta, which means that you are to offset the call delta at the time of trade with a fractional share of the underlying unit equal to 28%. In this case, that means for every one call you buy, you're selling 0.28 units of the SPX. In real life, market makers use the ES futures contracts to hedge their SPX trades. For simplicity, we're going to focus on the actual payoff profile and just consider a hypothetical unit of the SPX as the hedge asset instead of ES futures. Now, when you look at the examples I will ask you to graph, they'll always look something like this. Go through this diagram and identify the key bits of information. The price you pay for the call represents your starting P&L, and the reference there, 57.33 SPX, that's where you initiate your hedge. So if you're selling a unit of the underlying to hedge the option trade, you're selling it at a price of 57.33. This creates a handy starting point for your graph. What I mean by that is if you want to plot your first XY point on the profile, you would start out at 57.33 on the x-axis and minus 56 on the y-axis. Of course, because if you don't move at all, you have no P&L associated with your hedge. but you do in fact have a complete loss of the premium paid for the call of $56. Some other important points here. The slope of the overall profile will have a base that's determined by this hedge delta, or negative 0.28. And the overall profile will change or exhibit inflections on strike prices of options, because only at those strike prices does your position payoff change, and therefore your slope change. So once the call is in the money, you incorporate the plus 1.0 slope, reflecting the 100 delta at expiry. However, for all of the range for which the call is out of the money, that call contributes nothing to your payoff profile, and as such has a zero slope contribution to the graph. You'll see what this looks like in the end. The important takeaways. Once you hedge an option, you eliminate much of the directionality of the option. For example, if you were to ask somebody who's not familiar with options as hedged vehicles how you make money on buying an upside call, the obvious answer is that the market needs to rally, and to break even, you need to rally higher than the strike price plus the premium paid for the option. As you can see, once you hedge an option, you introduce a straddle-like characteristic to it, meaning you can observe a positive P&L in either direction, whether lower or higher. Of course, some amount of movement is required, and this is fundamental to options because in the end, when you're trading hedged options, you're looking for volatility as much as you're looking for direction. Interestingly enough, if you look at the break-evens, what you might notice after you do this is that it's easier to make money on this call, the downside, than it is to make money on the call to the upside once it's hedged. And this is a common theme that you'll notice throughout the rest of the payoff profiles that we do. When you buy an out-of-the-money option and you hedge it, as a market maker, you have an easier time realizing that P&L if you move in the opposite direction of it. For example, while most people think that in order to make money buying puts, you need to fall below the put strike, the reality is, as a market maker, when you're buying puts, your best case scenario is a drift higher and away from your put strikes, because that is where your hedge produces P&L. Now, walk through the calculations. The downside break-even simply found by taking the starting P&L that you observe at initiation, negative 56 in this case, and you have to find out how many dollars must you move if you're earning 28 cents per dollar to the downside on your short underlying component to completely overtake the $56 premium that you paid for the call and will not get back. In this case, the math is clean. You have to move $200 to the downside to overtake your premium paid and break even. This means that $55.33 is your first break even, and anything below that, you're in the black. Now to the upside, it's a little bit more complicated because we have two slopes in play. So again, we start out with that negative 56 starting point, and we have to figure out how much we lose on the hedge alone before we get to the strike price. To do this, you take the call strike minus the reference value, or where you initiated the hedge, that's 57.33, and you multiply that by how much money you're losing per dollar on that hedge. Turns out that when you do this, you're losing a combined $136.36 when you land on the strike itself. Now, once in the money, of course, the call is returning 1-to-1 on the underlying. It has a plus 1.0 slope, as it has a 100 delta, but you still have to account for the hedge slope, which is fixed throughout the entire graph at negative 0.28. Combined, the position slope with the call and the hedge together is then plus 0.72, meaning for every dollar above 60.20, you are making 72 cents. Of course, now to find the break even, you simply take that $136.36, your negative P&L that you're starting with on the strike, you divide it by 0.72 to figure out how many dollars you need to move to overtake the negative P&L. It turns out you need to move $189.39 through the strike price in order to break even on that side. This puts the SPX squarely at 6209.39, almost 500 points higher than when you open the trade. Interestingly enough, you're buying an upside call, but your break even to the upside turns out to be approximately 2.5 times your break even distance to the downside. This speaks to what you'll often see throughout these hedged option profiles. You make money quicker on your hedge when you're buying options out of the money. You want to move in the opposite direction and as far away as you can to maximize your P&L in these circumstances. Conversely, if you think through the lens of a short options trade, you might expect that the best case scenario then must be on the strike price itself, because the local minimum P&L for a long option profile is going to be the local maximum P&L for a short option profile. Which brings us to a basic takeaway here that you'll often hear me refer to. When you are structuring options trades, whether hedged or not technically, your best case scenarios tend to be moving far away from your longs, but landing on your shorts, no matter what the structure. So try your hand at some of these examples. We'll discuss them in Discord, and I will post the examples and the answers at the end of the week in the portal as well. Good luck.